Hi, I'm Wade McElwain, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we're looking at why an underperforming sector of both the stock market and the wider economy has sprung back to life. We also discuss how retail investors can look to take advantage of any further gains over the balance of 2021. The sector in question is energy, which was unloved for much of 2020 as the global pandemic put economies into lockdown, keeping drivers off the road and consumers at home. The entire travel and tourism industry was effectively mothballed for the year. That led to a global slump in demand for energy products and an oversupply of oil and gas that was exacerbated by a spat between two of the world's largest crude oil producers, Russia and Saudi Arabia, both of whom flooded the market with additional supplies. At one point, the oversupply was so large that there was literally nowhere left to store the excess crude. And in April last year, as U.S. crude oil futures expired, crude prices actually went into the negative territory, meaning that traders who were expected to take delivery of April crude oil were literally prepared to pay someone else to take it away from them. Thankfully, those extremes were very short-lived and oil prices quickly recovered, though they would spend most of the remainder of 2020 down by around 25 to 30% on the year before rallying once more in November. So what changed? Well, quite simply, it was down to two factors: the presidential election and the emergence of viable COVID-19 vaccines. Joe Biden's win in early November set the scene for more stimulus from the federal government in 2021 and beyond. More spending means more economic activity, and so more demand for energy, that much was clear. But you might wonder what the connection between drugs designed to prevent and contain a respiratory disease and the global energy market was. The answer is that with the emergence of drugs to limit the spread of the pandemic, traders and investors could actually see a roadmap back to normality and a reopening of the economy. As such, energy prices and those of energy-related equities rallied strongly. The vaccine news came less than a week after the election, and the two combined to make a heady cocktail of positivity. The S&P 500 energy sector jumped by almost 20% between November 4th and Christmas Eve. However, the energy sector was far from out of the woods and still finished the year down by more than 30%. But fast forward into the new year, and Saudi Arabia said it would cut crude oil production by an additional 1 million barrels per day during February and March. Shortly after that news, the closely contested Senate runoff elections in Georgia went to the Democrats, paving the way for a more expansive Biden presidency. That created another virtuous circle of expectations of more government spending, a quicker rollout of vaccines, and reopening the economy in 2021. The S&P energy sector added another 9.31% as a result. Now, of course, many of us are trying to reduce our carbon footprints and live a more environmentally friendly lifestyle, and renewable energy use is growing. But make no mistake, fossil fuels are going to be part of our energy mix for the next decade or two, at least particularly in highly populous developing economies such as China, India, Indonesia, and Nigeria, where more than 3 billion people live in total. So, how can retail investors position themselves to take advantage of any future rebound in energy demand? The good news is that there are plenty of choices. They can trade in the stocks of individual oil majors such as Exxon, Chevron, or ConocoPhillips, or they can look a bit farther afield and seek out the stocks which have been hardest hit over the last year. The reasoning could be that they have the most to gain in any continued rebound. For example, within the S&P 500, Occidental Petroleum is down by 55.36% over the last 52 weeks, while Apache Corp is lower 49.34% in that same time. Of course, if you prefer, you can take a view on energy prices themselves, and there are any number of ETFs to help do that. U.S. oil trades with the ticker USO and tracks WTI crude prices. It's up around 20% over the last 6 months. Alternatively, U.S. gasoline, which uses the ticker UGA, has bounced over 30% in the last 6 months. And if you want to diversify your portfolio by spreading the risks across the sector, then there are equity ETFs such as ticker XLE that specifically tracks the S&P 500 energy sector's performance. Trackstar IQ, our proprietary search tracking software, shows us that there have been 28 searches of XLE from 23 Wall Street pros over the last 30 days. Meanwhile, BOIL, the ProShares Ultra Bloomberg Natural Gas ETF, has received 33 searches from 23 separate institutional traders in recent weeks. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.